Hello, everyone. Good afternoon. Welcome to another one of our live events. I have here the honor to host Lukas Küemmerle. He's the founder and CIO of OhmResearch. He's based in Germany, and he's a specialist in commodities. And it's fantastic, to have Lukas here with us today for two reasons. Not only because he's an expert in commodities and he does fantastic work, but also because Germany is at the I would say epicenter of the hurricane, of what's happening today in terms of energy prices. So to kind of kickstart and to give it a background, next week on the 21st, if I'm not wrong, Thursday, that's when, in theory, the maintenance at Nord Stream 1 should stop, and in theory, from that day on, Russia can resume its gas flows to Germany. But nobody knows what's going to happen. I mean, and it's a very complex chess game. So we're going to cover today, of course, oil and gas, which is what's driving markets today, but also agro commodities and a little bit of metal. So without further ado, I'm going to hand over to Lukas. He will give his brief background intro, and he also has some slides to share, and then we'll cover we'll go to Q&A, and I have several questions to ask. And of course, if you have any questions from the floor, please just feel free to ask.
Well, thank you, Roberto. Thanks for having me on the show. Let's get into it. I mean, commodity markets are quite volatile over the past few weeks, mainly because recession fears kicked in. Some banks and analysts already predict a recession towards the end of 2022, the end of Q4. This sentiment is, of course, dragging down lots of commodities, and you can basically see it in all sectors, right? What my thesis there also is that a lot of speculative energy is dragged out of the market. We saw lots of speculators, speculative positioning in the market, and I think the current summer month and the period over the summer is a process where we see these positioning getting reduced. Maybe if we are able to show the presentation, we should start with some slides.
Yeah, we great enough. Yeah, let's go over the slides. Yeah, go to presentation mode.
Awesome. Let's do that. You can see everything?
Yeah.
Great. So basically what you see here right now is a broad commodity index, which is a CRB commodity index. It's a better example to measure the broader commodity performance than, for example, the Bloomberg index. In my opinion, that's because the energy weighting is here a little bit lower, and therefore the metals, the softs, and the grain composition is a little bit higher weighted. As you can see, we had a hell of a run since the beginning of 2020, sorry. And this really kind of peaked now a couple of months ago. We're approaching fast but steady the 200-day moving average, which is basically the orange line that you can see. And this is not only the case for the broader commodity index, it's also the case for single commodities. Basically, all commodities are nearing the 200-day moving average. And now things are starting really to become interesting because this will also be kind of the make or break zone for commodities, whether the long-term bullish trends will actually break, or if we see some consolidation and finally even higher prices in the months ahead. So this is what I would like to tell you about the broader commodity picture. Another thing that I would like to mention is Roberto already touched the theme quite a bit. I'm actually based in Europe, in Germany, and our big problem is to secure enough LNG or natural gas facilities to secure our energy providence over the upcoming winter. Nobody knows how cold the next winter will actually be. But as we know, for now, we don't have enough storage to get over the winter right now. This is also a huge factor when it comes to the euro, which is our main currency over here. We can see that the euro is or already has touched parity levels over the last hours. So basically, the euro is now as much worth as an US dollar. And you can really see on this chart, which measures the daily gas flows from Russia to Europe, that the exchange rate is very highly affected by this gas topic. And well, this is also the make or break zone for the exchange rate, whether we will see more gas flows from Russia to Europe again or not. And if we are able to secure enough inventories, we'll also decide about the future, the near or midterm future of the euro over here. If we go one step further and look at another important energy component, which is the oil market, these are data from the US market, which I'm mostly specialized into, actually. On the left chart, you see the weekly US ending stocks, including the SPR, so the oil reserve, and the green line is basically the crude oil futures price. As you can see, there's a high correlation between those. High inverse correlation in detail. We saw over the last 2 years that US ending stocks dropped and dropped and dropped. And my projection was basically that we will end up around 800 million barrels, which would equal a crude oil price about 140 to 150 US dollar. What was now happening is, as I mentioned at the beginning of the presentation, that we actually see many recession fears. We see so many signs of slowing economic growth, which is mostly visible also in all the PMIs from developed economies. And this actually led us to an uptick in weekly US ending stocks over the last 2 weeks. So we definitely see first signs of demand destruction because of high prices. And I think this is also important in the context that especially crude oil prices, but also gasoline and heating oil prices faced a harsh correction over the last few weeks. So everything is basically fundamentally justified to this point. Nevertheless, as you can see on the right chart, you see the inventory data in the historic context over the last 5 years. And what we see there is still kind of astonishing, because such a large drop in crude oil stocks isn't something that happens every day. And it's also something what leads me to my thesis that energy prices are high and will stay higher over the next month. Why is that? Well, I got you 2 charts here, long-term charts, which are about production and operable distillation capacity. Mm-hmm. As you can see on the left chart, crude oil production basically peaked out at the beginning of the COVID pandemic. And since then, we were not able to recover this crude oil production. We're still peaking out somewhat. On the right side, you see an even longer dated chart, which goes from 1987 to recently. And you can also see that at the peak of COVID, the US operable crude oil distillation capacity reached actually its peak. And this is quite of an important topic, because many analysts and specialists still see the maximum oil supply of the world that is needed peaking around the year 2030 to 2035. But there are near estimations which say that maybe 2040 is a more realistic goal. And if we see on the one hand that demand for oil and refined products will stay actually really quite high over the upcoming years. And we see on the other hand that production capacity and refining capacity is actually peaking out. Then this is really a fundamental factor that should support the long-term bullish energy thesis. On the other hand, I mean, many of you probably read the news that US CPI numbers yesterday came even again hotter in than expected. But from a wider point of view, commodities basically are, in my opinion, the best hedge out there against inflation. It's not gold, it's not Bitcoin, it's not stocks, it's not bonds, it's commodities. But the correlation actually between inflation expectations and the price of broader commodity indexes is quite high. And as you can see on the left chart, which are the 10-year inflation break-even expectations in the US, these inflation expectations actually declined for some time by now, even while the actual inflation numbers are still up and are likely to stay on these high levels towards the end of the year. But as you can see, the actual break-even inflation expectations are the real driving factor here. And this is also something that provides a drag to the overall commodity market sentiment, and is also why commodities don't move higher at the moment. Last but not least, we recently also saw this week the latest WASDA report numbers, so the ending stocks data of grains. Here also we see still very, very low stocks, but grains in general are also highly affected by weather data. And we see also some different trends in the grain market in general, where we maybe will speak about a little bit later in the show. Above you can see the fertilizer and chemical percentage share of the total operating costs of grains. And this is also an important point that I would like to point out, that the correlation between natural gas price and the grain price is actually really good. And that's due because of the fact that fertilizers are mostly produced by the input component natural gas. And that also leads to the conclusion that the percentage share of operating costs of grains is really skewed towards the high price of fertilizers. So if you look at grains, you always should look to fertilizer prices as well. On the lower chart, you see the FAO food price index. On the right chart below, you can see that we kind of peaked at the highest point ever. On the left chart, you only see these subcomponents in a more detailed form. But as you probably also read in the media, it's maybe the harshest environment for lower developed countries and emerging markets that they have ever experienced. Recently, we also saw an uptick in riots, for example, in Sri Lanka, in Albania. And this will probably also be a topic that will be in place over some months. Because yes, prices most likely peaked, as you can see at the index, but they are still at very, very high levels compared to the nearest history. And yeah, well, this was my introduction about charts. Now back to you, Roberto.
Yeah, no, this is great. Thanks very much, Lucas. I want to start, with a question. I mean, actually, there was a lot of talk, yesterday about, the director of the International Energy Agency saying that this is the most extreme energy crisis ever, and things are actually getting worse. So, what's your take on that? And I mean, do you agree with him? And the issue is, how did we get to this situation? Was this lack of investments? because of the pursuit to net zero, or how much of this is disruption because of the war in Ukraine?
I think I agree with him. I would say it's the harshest environment for energy resources that we've seen. Also due lack of investments and also investment potential in general. I mean, like we see, as I showed before in the slides, that production is not really ticking as much up as needed, and we're still far below the COVID peaks. And there are obviously some reasons for that. For example, we got these ESG label trend. Economies, especially over here in Europe, would like to go fossil fuel clear as soon as they can, and to provide Europe with as much green energy and to accelerate this energy transition as fast as they can. And on the other hand, if you, for example, are an oil producer and you think about investment decisions, you need planning security. And an important metric to look here actually is the crude or the oil forward curve. And if you would like to integrate new plants, or you would like to integrate new refineries, then you need planning security and high prices over long term. We still see that oil prices are kind of in a backwardation, not that huge that it was a few weeks ago, but still a backwardation. Producers haven't got this planning security because prices are in the future much lower than they are currently. And there are different statistics about how high prices actually should be at the longer dated end of the curve for wells in the US to actually produce profitably. And there we see something about $65 for new wells to produce profitably. And well, we're kind of quite away from these targets at the moment. On the other hand, as I mentioned, we don't have much tailwind from the political side of the equation. Everything is towards renewable energy to build out this infrastructure and shut down as much fossil fuel driven components as possible in the shortest amount of time as possible.
Okay, so and how, I mean, do you see, the situation, let's say, through, I mean, how long do you think, this the situation is going to last? I mean, do you see, I mean, at least throughout this winter, we're gonna move on with some more questions on the energy situation on the gas situation in Germany, but how much longer do you see this lasting?
I actually think the problem is not solved, it's just delayed into the near future. Roberto, as I mentioned before, the PMI data is slowing down rapidly all over the world. Recession is topic number one, trending on Google Trends at the moment. But the structural and the fundamental issues aren't solved in any matter. And demand for energy will tick up over the years as well. So I think what actually is happening here right now is that the structural problem is delayed into the future. Of course, we can see even lower prices in the near term. But longer term, I'm quite bullish on fossil fuels because I just don't see enough signs of production capacity actually ticking up.
No, that's interesting. And next week, before we move on to that, what's really happening to Russian oil? Do you think it is still in the markets, but going mostly to Russia and India at a discount?
Yeah, actually, I would agree with that, Roberto. I think the sanctions that the West is moving forward against Russia haven't got this high effect that they probably wish that would have. Russia is just basically very good in shipping their product into other regions of the world. And this is mainly China and India as well. They imported large amounts of Russian oil, and to about the 20 to 25% discount, which is huge if you look at current prices, which are still at elevated levels. So yeah, I think the product is still in the market, but it's not shipped towards Europe or the US, or the US don't really need it, but towards Europe, it's shipped to other places. And another important metric, if we look about capacity and what's actually in the market, we also have to talk about OPEC spare capacity, where I think the market is actually pricing in still some spare capacity from the OPEC. But we can see over the last 6 months, basically 18 out of 20 OPEC members weren't able to hit their initial production targets. And that actually makes me quite wary and think about, are they actually able to deliver on their goals, or what they actually say? If they're not able to hit their initial production targets. And another fundamental factor that actually confirms a more bullish thesis for oil.
And I mean, I struggle. I mean, I have a huge difficulty in becoming in grasping this idea about Yellen talked about it today, and there is a G7 heads talking about this as well, which is putting a price cap on Russian oil. I mean, how is that possible? I mean, and can that be enforceable?
I really don't think so. As we pointed out in the sentence before, actually, Russia is finding countries that would like to have their product. And if the EU is saying, well, we put a price cap on our imports or on the oil flows that come from Russia, well, then they will find another destination. The product oil is still very, very rare, and it's needed. So I think a price cap on oil in general isn't a good idea.
And can so talking about the gas situation in Germany, how how anxious, how nervous are people about what may happen in the winter? I mean, of course, it's a very hot summer, but nobody knows how the winter is going to be. Do you think Europe has the ability, to get enough gas, to diversify away from Russian gas? And when you look at the as we said, 3D chess game between Germany, or between Russia and Europe. What do you think the incentives are? I mean, if you were to evaluate, what are the reasons that could lead Russia to cut production? I mean, not to resume supply of gas to Europe, and what would make them continue to supply? I mean, what are the incentives right now, and how do you think the politics should work?
Yeah, that's of course the most important question over here right now. And I think in the media and also in the sentiment from the people over here, it's basically this one question: will Russia actually resume production over the one pipeline after July 2021?
First, yeah.
This is, of course, at the moment in the media, the most important question. And you really can feel it. You can feel it in the sentiment of the people. It's the number one topic if you talk about or talk with your family. It's in my case. But, well, it's, as you mentioned before, it's 3D chess. I don't really think that Russia wants to cut off Europe completely with gas flows, because in my opinion, they still need kind of these money flows also to keep their own economy running in kind of form. On the other hand, the real solution that Germany could do to support Ukraine to 100% with to shut off natural gas flows completely. But as we all know, this is economically not possible, because if Europe shuts down gas flows completely, this would be a terrible scenario for the industry. And because so many industries, the chemical industry in Germany is quite huge. If this would shut down, this would have so many consequences also on the labor market over here. And well, it's not only Germany, right? Italy also is dependent on the gas flows, as are many other countries in the EU. So it's quite a difficult situation. I don't really have made my mind about the question if gas flows will actually resume. I take the situation as it comes. But actually, I don't have much commodity positions at the moment. I'm mostly standing on the sideline and observe the situation right now. So yeah, very, very difficult situation for everyone, basically.
And I mean, I see that, you know, you had the head of you know, British Petroleum and Shell, and a lot of people talking about, okay, prepare for the worst and prepare for some rationing. I mean, number one, if let's say if gas flows are cut completely, what are the aspects that, you know, economists and people make about, you know, how much of a cut would there be to German GDP, and how long will it take, you know, you think, you know, for Europe to be ready to be completely independent of Russian gas?
I actually can't give you quite an answer about the GDP share that would be affected by those by the process. But as I mentioned before, it's quite a difficult situation. Europe is trying to secure energy from other partner countries around the world. But this process, without Russian flows, we won't be able to come over the winter. This is the current prognosis that I currently have. And yeah, I think it's hard to really speculate about what will happen in the next 2 weeks. Yeah.
No. Okay. And so yeah, it's you know, going to be, you know, very fluid, you know, on a day by day basis. We talked a little bit briefly about Biden and OPEC. Do you think it's possible that Biden gets any production increase, you know, or at least, you know, something to talk the market up and you know, manage expectations from his visit to the Arab countries?
I don't think you really have to be quite honest with you, because I think what's actually good for the Biden administration is right now that the price at the gas pumps is coming back. Basically, if you look at the,
because of demand destruction, right?
Yeah, of course. If you look at current Biden ratings and you compare it with the price of gasoline, it's basically the same chart. And
no, I saw the chart. The chart is very good, actually.
Yeah, it's good. If you, so that gets me back to your first question, and I think he don't really have to secure additional capacity from Saudi Arabia. And if you look at how Saudi Arabia basically produced over the last few months, they weren't quite able to hit their initial production targets. So I don't think he will come back with a lot of new flows from Saudi Arabia. But the current market situation is clearly in his favor, also regarding the midterm elections.
Can you move now, shifting to agricultural commodities? There's also something related to the war, of course. But, you know, I saw your charts, you know, in your post recently, that you know, some of the agricultural commodities had gone back to the levels before the war. Is that because there was a lot of speculation before? I mean, is there demand destruction? I mean, how is your outlook on agricultural commodities mostly? And do you believe that an agreement is possible, you know, to get, you know, the Ukrainian grain export it and at least avoid a global food crisis?
I think it will be hard to avoid a global food crisis because what we see or what is traded actually at the futures markets are future expectations. But as the FAO Food Price Index showed, prices are still at levels they're above levels we see at the GFC in 2008. Prices will remain high, and this will be a real struggle for underdeveloped economies. Especially if you at the point of a very, very strong dollar, which makes it even harder for those countries to import many agricultural goods. In general, I think the agricultural market will go from here very differentiated. The grain side of the market is, as I pointed out at the beginning, highly skewed towards energy prices, because diesel, petroleum, and nat gas are important components when it comes to operating costs of a farmer. This will play a huge role. As you said, we kind of see at some grains prices are back below when the war broke out in Ukraine. I think much of it has really to do with this washout of speculative energy in the markets. And I think the grain market could have a comeback once the most of the recession fears that we see right now are baked into prices. And you can kind of see it already that commercials go into the market aggressively and buy these positions back. So over the next months, this will be an important market to play. Your other question was regarding Ukraine and if they are able
the export of Ukrainian grain.
Yeah, I think that's difficult because we don't see really reliable data that we can really judge. What we see are news reports that Russia is using kind of Ukrainian grain facilities and ship them out of the country and sell them. But to be quite honest with you, I'm not the biggest expert into the field of how they really do the process and where those grain stocks actually are saved. So I can give you really a feedback about that.
No, interesting. And do you have any thoughts? I mean, we are already going through the 30 minutes plans, but do you have any thoughts on metals? I mean, of course, Dr. Copper is the biggest barometer for economic growth, and it's down as the same way as just like the other commodities. Is this is there a demand destruction already happening in not just copper but in other metals markets as well? And would you differentiate amongst them? Is there any one of them which you see particularly as more interesting?
Yeah, of course. Let me start with the fact that we actually see an uptick over the last 2 weeks in copper inventories. This is a clear indication that there is actually kind of demand destruction. And as you pointed out, Dr. Copper is there also the most reliable indicator when it comes to economic growth. Also, if you look at the copper price and the PMI, we saw a huge divergence between those two metrics over the last 6 months, basically. So the PMI was leading and copper prices were now following. Long term, I think copper is clearly undervalued because if we really want to go towards an electrified economy with everyone driving basically an electric car,
I agree.
It's really hard to imagine copper prices at these levels. And I looked recently up how long it actually takes to build out a copper mine, and it takes 16 years to go from the permission process at the current stage to actually see some copper flooding out of those mines. So the correlation between economic growth and copper is very strong, and therefore copper is not interesting at the moment. But also here we see commercials clearly buying into this dip. another market that will be highly interesting over the next month. On the other hand, we of course have the gold story. I'm not the biggest fan at the moment. I think many investors and people are actually quite a bit of worried or don't really understand why gold doesn't perform in this very inflationary, or let's say stagflationary environment. But we still see that gold is kind of holding up pretty good if you compare it with the driving factors that actually drives the gold price, which is the real yield, which is the liquidity that is getting provided, and especially if you put in context the very strong US dollar. Therefore, I still think gold is a safe haven, but nothing more and nothing less. We have some other metals. Silver, of course, is kind of a story in between, because a part of it is more industrial related. The other part is more like the gold use case. I'm not quite a big fan of the metal because it's not the one or the other. It's kind of the middle. For me, the two most important metals to look at are actually gold and copper. We see palladium, platinum, and also lithium, which are another important metals, especially lithium, holding up very, very good at recent highs. It also shows that demand for the metal is still quite strong. The metal will be needed over time once again to electrify the world. Palladium and platinum are still some use cases you see more in the automotive industry, especially palladium is needed for building catalyzers. Palladium is kind of in the process of being substituted by platinum. But those two markets are very, very illiquid and not the best place to trade them actually. So this would be my advice here: focus on gold, focus on copper, and lithium.
No, that's great. It's been a fantastic 40 minutes. Lots of insights. And if I actually have one question here from the floor. Tiago is asking if you think what do you make of the U.S. selling its part of its strategic petroleum reserve to lower prices? I mean, if that can be if they can be shooting themselves in the foot, or if that can be of any effect.
The only thing that I can really say about it is that the US is, of course, releasing SPR reserves to temper these high prices at the moment. So they inject these prices, these oil volumes into the market, and they will clearly have to buy back these reserves in a later stage of time to higher prices, because I think the US won't be able to buy back those inventories at the low prices that they bought them years ago. Because as I mentioned, I think we won't see a major super cycle in oil prices, but we see higher levels than we saw the years before.
No, that's fantastic. So is there anything else you'd like to say? I mean, like a 2-minute closing summary. I mean, if let me see. So you said stronger for longer commodity prices. In both in all of the three complexes. Basically because the markets are very tight, and there's been a lack of investment in the last 10, 15 years or so. But is there anything else you'd like to add, Lukas?
Yeah, from a risk management position, you should really be aware that the summer months are not the best months to trade commodities in general.
Yeah,
commodities are very illiquid over these months, and we also see the volume is very much down also in the major commodity contracts like crude oil. So as I said before, I think towards the end of August, middle of September, this will be the time again to look out for buying opportunities in the market. Everything that is highly energy related will find a comeback. And I also see some opportunities in some softs market that I discussed in my reports. Coffee will be a good example, and also cotton, but maybe we'll talk about this in a later stage.
Fantastic. So thanks again, Lukas. Thanks everyone that has joined us. We are going to do this on a regular basis. So I'll establish a timetable, a calendar schedule with Lukas, as well as with our other analysts. So thanks again, Lukas, and enjoy your weekend. It's been fantastic, awesome. Thank you.
Thank you, Roberto. Thanks for being about.
Thank you.